In today's video, we're going to talk about market gaps and how they can affect your trading. Before we get into today's video, I just wanted to let you know I actually have a sale running still on my trading academy. This is going to end on Saturday, I believe, maybe Sunday. What this means is you can get access to my full trading academy and community. Now that's a lifetime price, and that's going to be one of the best investments you make in yourself and in your trading journey. So if you want that, head over to the link in the description and I'll see you in the academy. Hello everyone and welcome back to the channel. Today I wanted to go over a topic that's going to be more relevant in these times of heavy fundamental news. We have a lot going on in the world. There is a war going on between Russia and Ukraine. We just come out of a pandemic. The economies are very beaten down. So there's a lot of uncertainty in the market and probably not the brightest of futures. Now, what this means is we get a lot of inefficiencies, we get a lot of large movements, and we get a lot of market gaps. So when the market closes for a weekend, when the markets reopen, a lot of the times we are going to see these big gaps because things change over the weekend and through the times that those gaps happen. What that leaves us with is big open price areas like this one here that we're looking at. And these price areas have some characteristics that are generally followed most of the time. So if you understand what I'm about to show you in this video, you can actually benefit from these gaps by knowing how to trade them and also how to avoid more losses as well. So let's get into it. There are two major characteristics that I've found from my personal experiences over the years and also through my testing that generally always happen or most of the time happen with gaps. These two characteristics are that they are almost always filled and that they almost always act as imbalance into a supply or demand zone. So what I mean by this is when we are looking at imbalanced supply and demand, for example, this here, supply zone with a large imbalance into it, we generally expect when that area is filled, we are going to see a reversal. So if price was to pull up like this, hit supply, and then we potentially reverse. Same here with this imbalanced demand. Now, obviously this one was taken out by the gap, but generally what we expect to see is the market pull back down into the demand zone and then move to the upside. Okay, so these work in very much the same way. It's like a very high probability imbalance, and when the market pulls through it, we are then likely to hit supply, for example, and react bearish. Okay, on the flip side, if this was a bullish gap and the gap was down here, we would generally go and fill down into that demand zone and then push to the upside. Now that isn't 100% guaranteed, but from my personal experience, and I've seen many gaps and I've traded many gaps, and through the heavy backtesting that I do, these are the two characteristics that stand out the most to me on gaps. So how can we actually use that in our trading? Well, the first big pointer is not to trade against gaps. Do not trade against a gap. And what I mean by this is if you see a short opportunity here, do not take it because the chances are we're going to push through that and go and fill this whole imbalance, fill the whole gap before reversing. So what you want to do instead of trading against the gaps is trade with the gaps and then trade with the supply when we get there. Now, if we just play price forward on this example, you'll see exactly what I mean, where we go through, we fill the gap, and then let's just mark out supply up here. When we hit the supply zone, we get a nice reaction to the downside. Okay, so you see we had to go and fill the gap first. The market wasn't ready to move down until the gap was filled. Now, as you can see, there was signs of reversal here, but we don't want to trade this because we still have an open gap above. Now, sometimes, yeah, we may just flip around from there and sell off, but the probability of that happening versus the gap being filled is extremely low. So I always recommend, and in my trading systems and in my trading rules, I will always wait for the gap to be filled before taking a trade. If it means sometimes missing this opportunity, that's fine, because I'm also going to miss out on many losses that happen within this area. And I'll actually catch the high probability, high risk reward winners when the gaps are filled, which I would estimate is probably around 70 to 80% of the time, to be honest, from what I've personally seen. Okay, so the number one big rule is don't trade against gaps. And why shouldn't you do that? Well, first of all, you're going to get better, high probability, high risk reward winners. And second of all, you're going to avoid a lot of losses that you would take selling here when the market actually goes and fills the gap and, clears your theoretical or hypothetical stop loss. So what I wanted to do now is go over a trade I sent out probably about 3 weeks ago at the start of the month. And there was so many people against this trade, so many people against the idea, but I just used exactly the same system I showed you and the trade worked out and the trade worked very nicely. So let's have a look at this then. Basically, GBP/USD gapped down like this, and then I was anticipating when we pulled into this area here, we would start to reverse. Now, the invalidation point for this trade, obviously here, which was also marked out, because if the market does push above that, shows the whole gap, the whole supply area here is filled, and the market is actually likely to then, continue to the upside. So what I was looking for was the market to reverse within this area here, below that invalidation point, then sell off just to target this low here, because there was actually a low time frame, I think about 5-minute imbalance, just at a guess around that point there, okay? So what I was looking for then was the market to come and fill the gap. Well, why was I waiting for that? Because as we just mentioned, that's a high probability thing to do. And then when the confirmation occurred, I was then going to sell the market and bring it down towards that imbalance point there. So if we allow the market to play out, you'll see that we did come up towards the gap. We did end up filling it. We hit supply. There was no confirmation given just there, but we did get confirmation to actually execute an entry a little bit later. So as we can see now, the gap has been filled. That means if we got confirmation for a trade here without breaking above the invalidation level, we would have a high probability setup on our hands. And as you can see, that is what came in at this point here. So if we just scale down here, what we can see is, first of all, the market approaches the gap, fills the gap, trades just above this preferred supply zone, but trades into this supply zone without breaking the invalidation level. Then we can see these higher highs and higher lows breaking down to a new lower low, as we can see here from this structural break. And then looking at this supply zone here at the top, really you could use the blue candle. Obviously refining down would give you a neater zone. We then could have obviously approached with an order, like so. Stop over the invalidation point, target into, whatever target it was we were looking for, somewhere down here in the lows. And then as we see, the market would have tapped you in very nicely and then made its run to the downside. So that is just a quick example of a trade, obviously using the gap, because what we can see here is potential signs of reversal. And I did not execute a trade there because obviously I expected the market could come up and trade through the gap before actually making the sell-off. So that's just an example of a trade managed using this gap, and the obviously trade idea formulated using the idea of the gap fills, avoiding myself losses in here and actually securing the highest probability, highest risk reward opportunities up here. So to recap on the points I've covered today and the knowledge I'm trying to give you to work with gaps a little bit better. First of all, don't fight gaps. So don't go selling into the market before a gap is filled. If an opportunity short comes around here, I would just simply recommend not to take that and to actually wait for the gap to be filled so you can get the highest probability setups, less losses, and bigger wins. Next thing, expect to see many more of these gaps in the near future. Because of the economic turmoil and the big fundamentals we've got going on right now, the geopolitical state of the market, so to speak, we are probably going to see many, many more market gaps occur because there's so much uncertainty, right? There's investor uncertainty, different currencies, different news coming out all the time. And what it does is cause these big inefficiencies in the market and these big wild swings. So expect to see more of these gaps and don't try to battle them. Treat them as imbalance. So generally, if you're going to sell and there's a gap above, treat it like there was an imbalance above and maybe cut off the sells. Don't take them until the imbalance is filled because we know that's where the high probability trades are going to come from. And then obviously when gaps are filled, as you've seen from these examples, we do often reverse. Now that's not guaranteed. Sometimes we will push all the way past the gap and continue up, but it's worth looking at the larger trend because obviously here we can see the market is clearly very bearish. So we can expect that, okay, if we come and fill this and get reversal confirmation, we are obviously likely to sell off. And one very important point that I forgot to mention, don't hold trades over the weekend. Now, obviously this comes down to your personal system. You shouldn't just take it as gospel from me. But obviously you've seen the damage that could occur if you do hold trades over the weekend. It's a very big gamble. Let's say you were long here because the market's obviously looking at like it's building some strength, and then you have a stop loss here or something. If the market gaps, your stop loss most likely will not be triggered and your whole account could get exploded, even if you managed your risk well, okay? On the flip side, obviously, if you were short, you'd have opened into a massive profit. But like I say, it's gambling, it's not trading. So my personal advice, my personal suggestion is to try and minimize how often you hold trades over the weekend. When we get to, these kind of crazy conditions, we have to tone our trading down, and holding trades over the weekend could essentially be catastrophic. All it takes is one piece of news, one large market gap, and your account is done for. So add that to the list and maybe test for yourself. But trust me when I say it can be quite dangerous now to hold trades over the weekend in conditions like this. So I hope you've enjoyed this video. I hope you've learned a few interesting pointers and some valuable information to help you lose less and win more. If you have, please do drop a like and subscribe. That's going to help me a lot. I will really appreciate that. And most importantly, I just hope you found some value from this video. So thank you for watching. Thank you for listening. I hope you've enjoyed it, and I will see you in the next one.